Welcome back, everybody, to another episode of Masters of Multifamily. I'm your host, Travis Watts, the Director of Investor Education here at Ashcroft Capital. Have a really exciting guest to present to you today. In fact, he's a returning guest here to this segment and show. His name is Carlton Dennis, and I will introduce him in just a minute. But I wanted to first preface what this video is and what the intent is. We're making a video today talking about K-1 tax forms, which is the tax form that limited partners receive when you decide to invest in a real estate private placement, or what some people refer to as a syndication. It is not the only use for a K-1. That could be used for many types of business models, but it is one that we issue as a company here at Ashcroft Capital. Now, we receive a lot of questions throughout the year. We're not licensed tax professionals. We can't give financial or tax advice. We're not CPAs, we're not tax strategists. So I wanted to bring Carlton back to the show to take a deeper dive specifically on K-1s to help answer any questions that you might have, whether you're a new investor or returning investor, and you're wondering what's going on with these tax forms that I get every year. Now, I didn't just want to bring a CPA here on the show today. I wanted to bring an enrolled agent here on the show, which is a higher designation. I'll let Carlton explain that. But without further ado, Carlton, welcome back to the show. It's great to have you here.
Yeah, absolutely. Grateful to be back. And I'm excited to go over the K-1. For many investors, it seems there's a lot of question marks when it comes to the K-1. So hopefully we can clear up some of those question marks today and give you guys a better idea of how investing in real estate can benefit you from a tax perspective.
I definitely want to give you just a minute here to give the listeners a little background on yourself, who you are, what you do, and then we'll dive into these K-1s.
Yeah, absolutely. So for the listeners out there, I'm actually a licensed enrolled agent, which pretty much means I have like a really high designation with the IRS to practice tax laws in all 50 states. So I primarily do tax strategy, which is helping investors and business owners leverage the tax code to the fullest extent to pay the least amount of taxes possible. I also run a tax and accounting company where I have over 20 CPAs who file returns and do bookkeeping and accounting services. So definitely want to make sure that I can help the tax industry out with the information that we put online. And so with today's training, my goal is to simplify something that seems very complex, which is understanding how real estate losses can really impact you on a K-1, making sure that you understand where they are and what you can do to leverage them if you're somebody that's trying to build wealth in the real estate space.
I love it. Thanks so much. So I'm going to preface this. If you want to go ahead and share your screen or get ready here to go over these K-1s, everybody watching, I wanted to use a real K-1 example. I didn't want to talk about a bunch of theory. This is one of my actual K-1s. Didn't want to, disclose the deal, the operator, things like that. So blocked out sensitive information for obvious purposes. But yeah, man, this is real life. This is what I do full time. And this is a value add multifamily private placement deal, or what some refer to as a syndication. I had invested $50,000 in 2019. We held the property from 2019, 2020. We ended up selling it in 2021. And then there was a partial distribution that was withheld at the time of sale to tackle any unexpected expenses that were possibly going to roll in. And I got a final distribution in 2022, which prompted the final K-1. So we're going to look at each of those years. And Carlton, I'll let you take it away. You're the expert here, and feel free to ask any questions as you go along.
Yeah, absolutely. So for those that are listening, this is Travis's 2019 K-1. And how we can know that is by looking at the center of this K-1. Right here, it says 2019. So this means that when the tax return gets filed, this is when we'll actually see this form come alive. Now, in order to understand what tax returns get filed, I'm just going to quickly jump to my iPad here just to share with you guys what a 1065 form looks like. So we file a 1065 tax return anytime we have partners. So if there's a partnership in place, such as a partnership investment or a partnership business, a 1065 tax return has to be filed with the IRS. And this is really just an information return, which means that the IRS just wants to understand, what did the business do? And with the information return being filed, the 1065 will push out K-1 forms to all investors or all owners of that partnership. And so when you guys see today us looking at this K-1 form here, this is exactly what comes after a 1065 tax form is completed. So hopefully that makes sense. Now, the one thing that Travis wants you guys to understand is, where would we even know how much money that he contributed to this investment? Well, if you scroll down here underneath part number 2, we will learn more about the information of the partner. Okay. So when I look at the information of the partner, I can scroll down all the way to the bottom in section L. And in this section, it lets me know my partner's capital account analysis. This is going to let me know what the capital contributed to the year was for Travis. And in the year of 2019, he contributed $50,000 to this partnership. So that's the very first thing that we want to know about this K-1 form. Why was it created? And the K-1 form was created because Travis decided to go into partnership and he contributed $50,000 of his own capital. And that's why we see this underneath beginning capital account. Okay. Now, the next thing that we want to understand is, what would be his percentage, right? If he's going into a partnership, maybe there's going to be other partners. Is there a way for us to be able to determine his percentage based on his capital contribution? And we're actually able to identify that. Here in line number J, we can see what beginning and ending percentages are, whether it's based on profit, whether it's based on loss, or whether it's based on a capital contribution. And in Travis' case, he invested capital into this partnership. So this is his percentage. We can see right here, 0.35%, based off of the $50,000 that was contributed into this partnership. So those are some of the basic things to understand about any time that you're going into partnership and utilizing a K-1. Now, let's make it very simple. How do we understand who owns the K-1? Well, now we go back up to part number 1, and this is where things get very simple. Under part number 1, you're going to have information about the partnership. Typically, you're going to have the partnership's employee identification number, which I'm sure Travis just wanted to make sure that that was blacked out for this meeting today. But you'll see the employee's EIN number. The partnership's EIN number is essentially the partnership's social security number, for lack of a better word, but it's truly how the partnership is identified. So the partnership is going to have its own name. The partnership's going to have its own address, city, state, and zip code that it's associated with. Maybe it's XYZ Real Estate Fund. Well, that XYZ Real Estate Fund should have an address, a city, a state, and a zip code. And it should also have an EIN number identifying that specific partnership so the IRS can track it for taxation purposes. Okay. Now, after we look at part number 1, part number 2 is where we get more information about the partner. So we know that Travis is the true partner of this partnership. And so underneath part number 2, I can learn information about Travis, or if you're an investor, this is where your information would be. You would have the social security number or a taxpayer identification number if you don't currently have a social security number in the United States. You would also be able to place your name, address, city, state, and zip code here if you're a partner. Now, if you decide to invest as an LLC, this would also be where you would see this information as well. Okay. Now, as you can see, this is a limited liability partnership. So the checkbox in part G is checked for limited partner or other LLC member. So this is an LLC managed partnership. And this is completely fine because most taxpayers will go into a partnership just as an individual. So if you go into a partnership as an individual, then in part number H2, I can identify if you are a disregarded entity, which is completely fine for a partnership for you to go in as just a solo member. So this is telling me a lot about how Travis approached this partnership. But what if he approached this partnership with a retirement plan, such as like an IRA or a SEP or a KIOG plan, right? These are all different various vehicles. So if he approached this partnership with a retirement plan, I would be able to see that in line 12 right here. If the partner is a retirement plan, IRA, SEP, KIOG, et cetera, check this box. And that gives us more information about who is contributing money to this partnership or capital to this partnership. Now, we've already discussed a little bit of information as it pertained to the beginning percentages and the end percentages. But down here, we're going to start to look at something that's really interesting. Travis contributed $50,000 in the year of 2019, but he received a current net income of negative 29,579. So you might be wondering, what contributed to this negative 29,579? And here's what I want you to understand. It's also present over here on the right side of the page at the top. Let's read what the right side of the page tells us. Part number 3, partners' share of current year income, deductions, credits, and other items. One of the many benefits of investing in real estate is that we get a lot of real estate tax deductions. But one of the most powerful tax deductions outside of writing off mortgage interest or property taxes or even management fees is the depreciation. And the depreciation is taken on the entire building's value that Travis and other members have decided to purchase through this partnership. Line number 1 tells me ordinary business income or loss. But you guys know if you're investing in real estate that it's not considered ordinary business income, it's considered rental real estate income. So we should see a 0 on this line. That would make sense. So when I jump to line number 2, I see net rental real estate income or loss, negative 29,579. So although Travis contributed $50,000 to this investment, right now he's reporting to the IRS that he's making negative $29,579 in a rental real estate loss. And this is really coming from depreciation. But this is interesting. If we're going to invest into a real estate deal, aren't we investing to get cash flow? Aren't we investing to make sure that we can build wealth? So what we're going to do is we're going to figure out, how does this real estate loss impact his ability to grow wealth? And is he receiving distributions from this partnership that he has decided to invest 50 grand in? Now, if we keep reading, there's a few other line items here that may make sense to you. You'll see other net rental income. Maybe there was other ways for him to receive net rental income from this partnership. Or maybe this partnership had him receive guaranteed payments for services. Sometimes we see this happen in private equity deals or in certain situations where a general partner is putting together this entire partnership. We might see guaranteed payments for services for the general partner who is managing the partnership. Guaranteed payments for capital. Maybe there's going to be guaranteed payments based off of the amount of capital that's been contributed to this partnership that's been worked out in the agreement of the partnership. And line number 4C is just the total of all guaranteed payments. So this is just following income. Now, there's other ways for us to have income inside of a partnership. Maybe we can have interest income. Maybe we can have ordinary dividends. Maybe we can even have qualified dividends. But all of these different forms of income that can come from the partnership needs to be tracked. And this is how the IRS tracks your income when you decide to file a 1065 tax return. I work with a lot of actors and actresses who own partnerships, and they receive royalties based off of the items that they might have sold, such as their record tapes. And then you'll also see here is if you ever sell real estate or sell assets, that you might also be subject to short-term capital gains or long-term capital gains based on how long you held on to the asset. Underneath this item, 9A, also gets real interesting. There's a few other line items here that most taxpayers are unfamiliar with. 9B, collectibles, which is taxed at 28%. Unrecaptured, section 1250 gain, which is pretty much depreciation you did not accelerate on a property that you're selling and regaining. Section 1231 gain, which is like capital gains on a property, the actual gain on a property when you sell it, and other income or losses. Now, we also have down here at the bottom, Section 179 deduction. The reason why Section 179 deduction is here is in the event that the partnership decides to administer Section 179 deductions for their partners, we can track what type of Section 179 deductions the partner may be receiving. In order to simplify this, I want you to imagine that a Section 179 deduction is any qualified piece of equipment that has a useful life of less than 20 years. Maybe it's a washer, maybe it's a stove, maybe it's an appliance. But if it is written off in less than 20 years via the 179 deduction strategy, we would see this information here. And then we also have other deductions and then self-employment earnings and losses, which most people won't see here unless they're dealing with a self-employed business. Now, here is the right side, 15. Credits, foreign transactions, alternative minimum tax, tax-exempt income and non-deductible expenses, and distributions. Distributions lets us know what are we actually receiving from this partnership in the form of a distribution of cash or credit that could be taxable income to us. In this year of 2019, based off of Travis's $50,000 capital contribution, he received distributions of $1,833. Now, for most, they would view this distribution and see that there's probably taxes that have to be paid on this amount. But what I want you to understand is there's a net rental real estate income loss of $29,579. What this means is that this loss being on the same form as this distribution is counted as a deduction against the income that we just added up. So this $29,000 loss is actually what we as taxpayers would see on our normal 1040 tax return when we actually move forward in filing our individual return. So to make matters even simpler, after we receive a K-1 form, we as taxpayers are going to want to file our 1040 tax return. Our 1040 tax return is considered an individual return. Whether you're married or single, it's still considered an individual return. But our 1040 actually records our K-1. So if our K-1 is reporting a $29,000 loss, just to round down to make it simple, then this loss can offset other forms of income depending on what that other form of income is. So if I happen to have other stock income or other capital gain income, this $29,000 can offset that other income. But what happens if I don't have any other capital gain or any other investment income to offset? Well, this is where real estate really becomes fun. Now, in the year of 2024, when I file my tax returns, I will receive 80% of this $29,000 as a loss inside of my individual 1040 tax return when I file the following year. And this is one of the many benefits of investing in real estate is although that I paid $50,000 to be in this partnership where we're investing in real estate, I am receiving cash flow every single year from being an investor. One of the benefits of receiving cash flow from being an investor is I'm also receiving depreciation. And depreciation creates this beautiful tax loss on my returns. When I file my returns, I get to claim that tax loss. And this tax loss can help me build wealth to offset new forms of taxable income as it carries forward into future tax years. And so this is Travis's 2019 K1 here. As we jump over to 2020, you'll notice that we see distributions have increased and that his losses will continue to travel forward with him. And I know this because I filed tax returns probably for 500-600 real estate investors. And one of the real benefits of being an investor is you really, and when I say really, I would say 9 times out of 10 are not really ever experiencing a taxable event unless you actually leave real estate, which when I really think about real estate investors, they're normally in it for the long term. So most of the time they're going into real estate with the intentions of staying in real estate because they truly believe in real estate as that correct asset class for them to build wealth. Well, if you're a long-term real estate investor, you're going to develop long-term real estate strategies. Like staying in real estate long-term could look like you providing a 1031 exchange strategy to your portfolio to keep you in real estate so you never experience a taxable event. But here's the distribution that we get to see that Travis experienced on his 2020 tax returns. The cool thing about being in real estate is the longer you're in real estate, the more you typically get paid because you're paying down the principal. And normally in the first year of going into a partnership, whether it's a partnership syndication or a partnership joint venture, depending on where you get into the deal, maybe it could be at the end of the year, which is part of the reason why we only saw maybe $1,800 on Travis's 2019 K1 versus the 4,125. Maybe this is a full 365 days of cash flow that he is receiving on a 50K capital contribution, right? So it's a really great way for us to be able to learn how he's building his wealth with this partnership deal that he went in it. Now, here is in 2021. Look at the changes that occurred in 2021. We're now seeing a distribution of 72,315. My question to Travis would be, did anything change in this year of 2021? Was maybe there renovations that were done that all of a sudden led to more cash flow, or an amenity might have been added into this real estate deal, or maybe there was some type of liquidation event or a property was sold and he's receiving a bigger distribution. So let's ask Travis what happened in 2021.
Yeah. So 2021 is when the partnership dissolved and we sold the property. So investors at this point had the option to 1031 exchange. In this particular deal, I had opted out of that option. So I think what that's reflecting there in 19A is the 50,000 return of capital plus some gains on top of that from the equity upside.
Nice. Yep. And we can definitely see those gains here, right? Because we have the unrecaptured section 1250 gain, and then we have the net section 1231 gain, which is his total gain from his capital contribution and his cash flow coming back to him.
Something to point out here too is, President Trump, and I think it was 2017, correct me if I'm wrong, he put in the Tax Cuts and Jobs Act where we were allowed to basically take 100% bonus depreciation at that point moving forward, which this deal fell into that category. As you alluded to earlier, it's now 80% and kind of moving downward and phasing out. But this operator I was investing with did what's called a cost segregation study to accelerate the tax benefits. So
Yes.
if there's anything you want to touch on with that, just to help
absolutely.
clarify what that is or how that works.
I'm a big fan of the cost segregation study because it is our tool as tax strategists to be able to help our taxpayers reduce their tax bill with real estate. And so the cost segregation study allows for us to write off components in the house, the investment property that has a useful life of 27 years or less, and recategorize those components into 5, 7, 10, and 15-year components. And when we do this, what ends up really happening on the tax return is we force this big paper loss. And that is part of the reason why most real estate investors who are going into deals avoid the taxation on the cash flow, is because the cost segregation study is done typically within the first couple of years of ownership of the property. And to kind of explain what a cost segregation study is like, just so I can show this really quick, right? So we have these buckets. And when you're dealing with a residential property, Typically, a residential property is being depreciated over the course of 27 and a half years, which is actually a really long time when you think about it. I'm 29 years old. I know I personally wouldn't want to wait 27 and a half years to receive all of my depreciation. And so, what most savvy real estate investors will do is they will perform what's called a cost segregation study. And it could be a mouthful. We say CSS for short in the tax world. But what a cost segregation study allows for us to do is allows for us to determine tangible personal property, qualified improvement property, and land improvements from the building and segregate them into 5, 7, 15, and we'll keep some of the components in the 27 and a half year bucket, which would be like the base of the building and the roof and things like that. The foundation would also stay in the 27 and a half year. But on average, about 20 to 30% of your building is able to be accelerated. And this ends up creating such a big loss for the investors. And so land is not depreciable. So what we're doing as your tax strategist is we're separating the land from the building, and we're choosing to reallocate it into these various different buckets that you see here, 5, 7, 15-year bucket for qualified improvement property, and then land improvements as well.
On that, the K-1 that we were just looking at, I wanted to purposefully show a cash out scenario. Not every investor will want to participate in a 1031 exchange, though that may be a great tax strategy for some. And some operators in this space just simply don't offer that. Or there's always the potential that even if an operator historically has offered it, maybe they can't find a deal that pencils or something like that. So I just wanted to show people potential tax consequences by not doing a 1031 exchange, and then talk about kind of what that looks like or may look like on the back end.
Yeah, absolutely. So anytime we choose not to do a 1031 exchange, we're going to be subject to the taxes of the depreciation that we've claimed, which is called the which is called depreciation recapture to many taxpayers. And then we're also going to pay taxes on the actual gain of the property, right? So let me make an example so it could be super simple. Let's say in the year of 2019, we purchased a property for 100,000. And then let's just say by 2023, that same property is worth 500,000. So we have a $400,000 spread, right? But if I place this property into rental use, as the IRS would say, then I'm able to claim depreciation. And as soon as I claim depreciation on the property, that's my write-off. Let's say that I took $50,000 in depreciation between 2019 and 2023. Well, that means between these two items, the 50,000 that I took in depreciation and the 400,000 in appreciation of the property, I'm going to have a $450,000 worth of tax exposure to deal with. This amount, since I've held the property for longer than 365 days, will be subject to long-term capital gains, which could be 0, 15, and 20%. But this over here is going to be subject to ordinary income tax rates, which can go all the way up to 37%. And this is how I see most taxpayers not be able to build wealth as fast as they would like, is because they're unaware of depreciation recapture, and they're unaware of the tax consequences of selling an asset versus doing a 1031 exchange. When we decide to do a 1031 exchange, what we're essentially telling the IRS is we're going to sell our property, but here's the thing. I'm going to stay in real estate. I know that my property in 2019, I purchased it for 100,000. In 2023, it's worth 500,000, and I have this $400,000 spread. But rather than cashing out and taking this myself, I'm going to have this go to a 1031 accommodator instead. Someone who can hold on to the money as I identify a new property that I wish to buy. And if I decide to take my money and roll it over into another investment, that 400K, I can avoid 100% of the taxes on the depreciation that I took, which was that 50,000, plus the 400K gain that I would have received personally if I had just sold the property and chose not to do a 1031 exchange. So the 1031 exchange accommodator is going to give me some time to be able to close on this property. They're actually going to give me 180 days to close on this property. But here's the thing. This property that I buy needs to be equal in amount to the property that I sold, or properties that I buy need to be equal in amount or greater than the property that I'm planning on selling. So that way, it's all a part of the 1031 exchange tax law compliance. So I don't have to pay any taxes. So if I buy two assets, whether one asset is worth 200,000, the other asset's worth 300,000, both of these assets make up 500,000, and I'm selling my property for 500,000. This is considered a qualified 1031 exchange. But if I try to buy an asset or roll over into an asset that's not equal or greater value, then that's considered a failed 1031 exchange, and then I might be subject to taxation. And so understanding this 1031 exchange rule allows for real estate investors to continue to stay in real estate, avoid taxes, and use the appreciation from the deal, right? Their capital return that they get from the deal, and roll it into the next deal without any tax exposure.
Appreciate you going into detail there. Let's hop back to the K-1 on 2021 when the property sold. Any final thoughts on that? Again, this was a deal I chose not to 1031 with, but keeping in mind what Carlton alluded to, long-term capital gains and a portion of depreciation recapture, which I believe, correct me if I'm wrong, it has a max percentage to the tax, right? It's like 25% or something like that.
Yes, that's correct. Unrecaptured Section 1250 gain is subject to 25% flat tax rate. Section 1231 gain is your true gain on the property, subject to long-term capital gains rates.
Great, thank you. So even in this scenario of me making that decision not to defer taxes, which may have been the ultimate tax strategy in that case, still tax advantaged from the standpoint of not paying the ordinary tax levels if your bracket happens to be what Carlton pointed out, like 37% or something like that.
That's correct. 100%. That's 100% correct.
Perfect. And one more thing on this. This was the year it sold. Obviously, the next year, it's common in this industry that when they send final distributions to the limited partners, there's some that's held back for any expenses that may pop up. So the 2022 K-1 was my final K-1, and it had some form of additional distribution right there, as you're highlighting, a couple thousand that came out. So anytime there's going to be a transaction in a given year, it's likely going to prompt a K-1, which is why I had that the following year.
Yeah, that's correct.
And it's marked there at the top two final K-1. So that's another indicator to know, are you going to be getting a K-1 potentially the following year?
Yeah.
You did a tremendous job, man. I appreciate, all the visuals. Can folks reach out to you if they have any additional questions or want to learn more about you and your business?
Yeah, absolutely. So we're on all social media platforms. You'll probably run into me on YouTube. We have a growing YouTube channel. I think we're well over 500,000. So feel free to hit the subscribe button. If you guys are looking for any tax services, you can reach out to our tax and accounting company, KDA. And we have well over 40 individuals at that firm that'd be more than happy to assist you on any tax strategies as it pertains to your investments. And if you have any questions, if you'd like to reach out and just ping me, you're more than welcome to reach out on Instagram. I'd be happy to get in contact with you.
Well, thank you again, Carlton, for coming on the show here today. Reach out to Carlton if you have any additional questions or want to learn more about his services. If you'd like to learn more about Ashcroft Capital Value Add Fund 3, it is open for investment to accredited investors, 506C offering. You can visit avaf3.com for more information, or ashcroftcapital.com for more information on us as a company. If you have any specific questions, you can reach out to investors@ashcroftcapital.com or myself, Travis, at ashcroftcapital.com. Always happy to point you in the right direction, get your questions answered. Thanks so much. You're listening to Masters of Multifamily, and we'll see you in the next episode. Take care, everyone.